Welcome to this lesson on debt covenants, a critical component of credit analysis. Debt covenants are contractual provisions that protect lenders when they extend loans to businesses. Understanding these provisions is essential for anyone working in finance, credit analysis, or corporate lending. Throughout this video, you'll learn what debt covenants are, why they exist, and how they protect lenders while still allowing borrowers to operate their businesses effectively. Debt covenants are contractual agreements between borrowers and lenders that impose specific restrictions and requirements on the borrower's operations and financial management throughout the loan term. Think of them as rules that the borrower agrees to follow for as long as the loan is outstanding. These agreements are legally binding and are typically written directly into the loan contract. They serve to protect the lender's interests by ensuring the borrower maintains financial discipline and doesn't take actions that could jeopardize their ability to repay the loan. Debt covenants serve four primary purposes. First, they provide risk mitigation by protecting lenders from borrower actions that could impair repayment ability. Second, they act as an early warning system, providing signals of financial deterioration before an actual default occurs. Third, they ensure alignment of interests by making sure the borrower maintains conservative financial practices that benefit both parties. Finally, they give lenders intervention rights, enabling them to take corrective action when covenants are breached. Together, these purposes create a framework that balances lender protection with borrower flexibility. Debt covenants fall into two main categories: affirmative and negative covenants. Affirmative covenants specify actions the borrower must perform, such as providing financial reports or maintaining insurance. These are positive obligations that require the borrower to do something. Negative covenants, on the other hand, specify actions the borrower must avoid, such as taking on additional debt or paying excessive dividends. These are restrictions that prevent the borrower from doing certain things. Both types work together to create a comprehensive framework for managing the lender-borrower relationship. Affirmative covenants require borrowers to take specific actions throughout the loan period. Common examples include providing periodic financial statements and reports, which give lenders visibility into the borrower's financial health. Borrowers must also maintain proper insurance coverage on assets to protect the collateral securing the loan. They're required to comply with all applicable laws and regulations to avoid legal issues that could threaten repayment. Additionally, borrowers must continue business operations in the ordinary course, meaning they can't drastically change their business model without lender approval. These requirements ensure transparency and stability. Negative covenants place restrictions on what borrowers can do during the loan term. One common restriction limits dividend payments to shareholders, ensuring that cash stays in the business to support operations and debt repayment. Lenders also typically impose limitations on additional debt or borrowing to prevent the borrower from becoming overleveraged. There are usually prohibitions on selling or disposing of major assets, which could weaken the company's financial position or eliminate collateral. Finally, restrictions on mergers and acquisitions prevent the borrower from making risky strategic moves without lender consent. These restrictions help preserve the borrower's financial strength. Financial covenants are quantitative metrics that borrowers must maintain throughout the loan period. The debt-to-EBITDA ratio measures maximum leverage allowed relative to earnings, ensuring the borrower doesn't take on excessive debt. The interest coverage ratio requires minimum earnings to cover interest payments, proving the company generates enough cash to service its debt. The current ratio mandates minimum liquid assets relative to short-term liabilities, ensuring the company can meet its immediate obligations. Finally, minimum net worth requirements establish a required equity cushion to absorb losses. These metrics are tested quarterly or annually and provide objective measures of financial health. When a borrower violates a debt covenant, several consequences may follow. First, it triggers a technical default, requiring immediate notification to the lender even if the borrower is still making loan payments. This often leads to increased interest rates or additional fees as the lender reprices the risk. In severe cases, the lender can accelerate the loan, requiring immediate full repayment of the outstanding balance. However, not all covenant breaches end badly. Borrowers can request renegotiation or waiver of the violated covenant, though this typically comes with amended terms that are more favorable to the lender. The severity of consequences depends on the nature of the breach and the borrower's overall financial condition. The strictness of debt covenants varies based on several factors. Borrower credit strength is paramount. Stronger borrowers negotiate more flexible covenants, while weaker borrowers face tighter restrictions. The industry risk profile matters too, with riskier industries facing stricter covenants. Loan size and terms also play a role, as larger loans typically come with more comprehensive covenant packages. Competitive market conditions affect covenant strictness, with tight credit markets leading to stricter terms and loose markets favoring borrowers. Collateral quality influences covenants as well, since strong collateral reduces lender risk. Finally, relationship history between the borrower and lender can result in more favorable terms for trusted, long-term clients. Let's review the key points. Debt covenants are contractual safeguards protecting lenders from borrower actions that could impair repayment. They're not meant to be punitive, but rather to ensure responsible financial management. Covenants balance lender protection with borrower operational flexibility, allowing businesses to function while maintaining financial discipline. Both affirmative and negative covenants work together to create this framework, with affirmative covenants requiring positive actions and negative covenants preventing risky behaviors. Finally, covenant strength depends on borrower creditworthiness and market conditions, meaning the specific terms vary significantly from loan to loan. Understanding debt covenants is essential for anyone involved in corporate lending or credit analysis.
If you like this video, hit that like button and don't forget to subscribe. Visit codelucky.com for more such useful content.